Welcome to my tutorial on Introduction to IFRS 16, Leases. If you are coming across my lecture for the first time, please like the video, also share it with others. If you are a returning subscriber, I say thank you for being part of this channel. What is a lease? Lease is a contract. Lease is a contract or part of a contract that conveys the right to use an asset for a period of time in exchange for consideration. A contract or part of contract that conveys the right to use an asset for a period of time in exchange for consideration. A lease contract is a form of landlord and tenant relationship. It's a form of landlord and tenant relationship in which the landlord, that is, landlord is the lessor in this case, conveys the property to the lessee, that is, the lessee is the tenant, in exchange for consideration called rent. The landlord conveys the property to the lessee in exchange for consideration called rent. So there are two parties to lease, parties to lease. We have two parties to lease. The first party is the lessor. I've told you lessor is the landlord. Then the lessee. Lessee is the tenant. Who is a lessor? A lessor is the entity that provides the right to use an asset. The entity that provides the right to use an asset in exchange for consideration. Lessor is the entity that provides the right to use the underlying asset in exchange for consideration. Lessor provides the right to use the underlying asset in exchange for consideration. Then the second party is the lessee. Lessee is the entity that obtains the right to use the underlying asset in exchange for consideration. I told you the landlord, that is the lessor, provides the right to use the underlying asset in exchange for consideration, while the lessee obtains. That right is obtained by the lessee from the lessor. The entity that obtains the right to use an underlying asset in exchange for consideration. So we want to look at the terminologies used in lease. Definition of terms. Definition of terms. The number one term we will examine is commencement date of a lease. Commencement date of a lease. Commencement date or commencement date of a lease is the date on which a lessor makes an underlying asset available for use by a lessee. The day or the date the lessor make an underlying asset available to the lessee for use. That date is known as commencement date. The date the lessor make an underlying asset available to the lessee for use. That date is known as the commencement date. Now, that is the date the lessee starts to use the asset. The date the lessee starts to use the asset is known as the commencement date. Then the second term we will examine is the lease term. Lease term. Lease term can be divided into two. The lease term can be divided into two. We have the primary period and secondary period. Primary period and secondary period. Secondary period. Lease term will be divided into two. The primary period. The primary period is the non-cancelable period. Non-cancelable period. That is the period in which neither of the parties to lease can cancel the lease agreement without penalty. Neither of the parties, that is, neither of the lessor and the lessee, can cancel the lease contract or lease agreement. If they cancel it, that means they will suffer some penalties. So the second period is the secondary period. The secondary period is the period of the option. Period of the option. When you have an option, that is, you have the right to choose. The period you have the right to choose. You can choose to exercise the right and you may terminate it. I've told you the non-cancelable period, neither of the parties to lease can terminate the lease agreement. Neither of them can terminate the lease contract. But the option period, both parties, either of the parties have the right to terminate the terms of the contract. The lessor can terminate it if he wishes, and the lessee may choose to terminate it. So that period, the period they have the option to decide on their own. They have the option to decide whether to terminate the lease agreement or to continue with it. So that is the period of the option. So this period of the options will be divided into two. You have the option to exercise the lease. The period you have the option to exercise the lease. That is, if the lessee is certain to exercise the option. So he is certain to exercise the option. And the lessee is certain to exercise the option where the payment for the period of the option is very small compared with the amount payable in the non-cancelable period. So the amount that we paid here will be very small. For instance, you want to rent a house from a landlord. Remember, I've told you the lease contract is a form of landlord and tenant relationship. You want to rent a house. The house is newly built, and the landlord say, okay, you can be paying 100,000 naira per annum. So for the first 5 years, and when the house is still very new, you are paying 100,000 naira for the first 5 years. So ignoring inflation, maybe after 5 years, the contract has to be renewed. So the landlord, after the 5th year, after the end of the first 5 years, you can decide whether to continue living in the house, and you may decide to move away from the house. So if, let's assume after the end of the 5 years, the landlord say, okay, any subsequent year payment, you should be paying 5,000. In this case, this 5,000 is very small, so you may want to utilize that opportunity to stay in that house because the rent for the period of the option is very small. But where the landlord say, okay, after 5 years, so I'm going to renew the rent. The amount you'll be paying is 500,000. In that case, if you'll be paying 500,000 after the first 5 years, when the house is aging, you will decide, okay, can I stay in this house? You're staying in that apartment will still be in probability because the amount payable in option period is very higher compared with the amount you were paying in the initial period of the lease, in the primary period, which is the non-cancelable period. So in that case, where the rent for the period of the option is very high, that means the probability of you accepting these terms of the option. That is, your acceptance of the option terms is in probability. You are not sure. It is not highly probable that the option will be exercised. That means where the rate for the period of the option, where the renter for the option period is very high, that means the probability of accepting that term is very, very high. So that means you may not want to accept the terms of the option. But if the option period is just 5,000 and you have been paid 100,000, this is an opportunity. So instead of you looking for an apartment elsewhere and be paying 300,000 or more, so it will be better for you to stay in that option. That means it is highly probable that the option will be what? Will be exercised. So, but if it is not probable that the option will be exercised, that means the period of the option will not form part of the lease term. So, meaning that the lease term will comprises the primary period, that is the non-cancelable period, plus the option period, where it is highly probable that the option will be exercised. That means the period of the option will form part of the lease period, where it is highly probable that you will accept that option term. But where it is highly probable not to exercise the option, that is, it is not sure that the option will be exercised, that means the lease period, the option period will not form part of the lease term unless the termination penalty is attached. Example 1. XPS signed a contract for the lease of an asset. Terms include non-cancelable term, 5 years, at an annual rental of 100,000 naira. Option to extend for a further 5 years at an annual rental of 1 naira required. What is the lease term in this contract? Now, before you can identify the lease term, you know you have non-cancelable term. That is, this is the primary period. Neither of the parties to the lease can cancel the terms of the lease agreement, or neither of them can cancel the lease contract. So that means the primary period, the non-cancelable period, is always part of the lease term. So these 5 years will be part of the lease term. Neither of the party can cancel the terms of the lease contract. Then, before you can decide whether the options period will form part of the lease term, you have to ascertain whether the option will be exercised. Now, I have told you where the renter for the period of the option is very small. That means the lessee will want to make use of that opportunity. Therefore, in that case, the option will be exercised. Now, let's look at this question. Option to extend for a further 5 years at an annual rental of 1 naira. This rental is very small. The rental is very infinitesimal. That means it is highly probable that the option will be exercised. Since the option may be exercised, the lease term now, lease term will now comprises of primary period, that is the non-cancelable period, which is 5 years. Then plus period of the option, since the option will be exercised. So period of the option is another 5 years. So the lease term now will be 5 years plus 5 years. So we have 10 years. So the lease term is a period of 10 years since the option may be exercised. So the option period will form part of the lease term. Example 2. XPSC signed a contract for the lease of an asset. Terms include non-cancelable terms, 5 years, at an annual rental of 100,000 naira. Option to extend for a further 5 years at an annual rental of 200,000 naira required. Determine the term of the lease contract. Now, solution. The lease term always comprises of non-cancelable period. I've told you that the non-cancelable period is the primary period of the lease, in which neither of the parties to lease can cancel the lease term. So, in this case, 5 years is the primary period. Then, plus period of the option. Now, I've told you that the period of the option will form part of the lease period or lease term where it is certain that the option will be exercised. And I've told you that the option will be exercised where the rental for the period of the option is very small. Now, you were told option to extend for a further 5 years at an annual rental of 200,000 naira. In the primary period, you will pay 100,000 naira. Then the option period, as this lease asset is aging, you have to pay 200,000 naira. In that case, you may not want to exercise that option. So that means the option may not be exercised. So since the option is unlikely to be exercised, so the lease term will be 5 years in this case. Now, that is the solution to the question. So I will stop this video here. In my next video, I will examine the accounting for lease. Please drop the love emoji, like the video, and also share it with others. Thanks for watching ZICA.